This is Matthew Cratter from Trader University, and today I want to talk about how to write covered calls on silver. And for this I'm going to be using the silver ETF, which is SLV, but you could apply the same principles and write covered calls on gold as well. It's a little more high priced, but that would be GLD. If you're interested in learning how to make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So obviously silver has had a really nice run in 2020. It's recently gotten a bit choppy, but one of the good things about choppiness in a market is that it leads to higher premiums on the call options. I'm going to link to a video below. If you know nothing about call options, you can watch that. I'm going to assume that you know something about it, though even if you don't know a whole bunch, you'll still be able to follow along with this trade. So the next thing I do is I just go to Yahoo Finance, I type in SLV up here, and then I click right here where it says options. And then I scroll down, and there's a drop down here where we can pick the expiration. I like to use calls when I'm doing covered calls that are about 45 to 60 days from expiration. So it is currently August 16th, so we're going to use the October 16th calls, the calls that expire on October 16th. Now it's nice the way that Yahoo does this. You can see that everything is sort of blue shaded here. That would be for all the calls that are in the money. And what I usually do when I sell covered calls is I pick the next strike price up from where silver is currently trading, from where the stock or the commodity is that's currently trading. So silver closed Friday at 24.58. And so when you're selling covered calls, at least the way I do it, I usually pick a strike price that's just either right at the money. So if they had a 24.50 or something like that, I would use it, or just directly out of the money. Actually, they do have a 24.50. I'm still going to choose the 25 strike price. So these are the 25 calls. They're slightly out of the money, and they are expiring in approximately 60 days from now. We can see that the bid is currently at 238, offered at 239. Obviously, the market's closed because it's a Sunday morning. But this is the basic trade we're going to do. You could also do the 24.50, and that will turn out roughly the same. Some things will be different, but I'm going to teach you how to adjust for that. Again, none of this is investment advice, just the way to set up the trade if you decide to do it. So how does this work exactly? Well, you only want to do this trade if you think silver is going to stay around here, is going to stay in the mid-20s or go higher. If you think it's going to fall a lot, this trade doesn't make any sense. Also, if you think it's going to go to 100 or something, you don't want to give away the upside, because when you sell covered calls against something, you're basically giving away the upside. But the nice thing about this is it does create some sort of instant income depending on how things work out. It's obviously counted as a short-term capital gain, but let's see how we do this. So basically, if things open where they are right now on Monday, we would just buy 100 shares of SLV at 24.58, right where they're trading. They may open up or down, so you may have to adjust this. That would cost $2,458. And for all of this, I'm going to be ignoring commissions. If you do it on a platform like Schwab or Robinhood, you don't have to pay any commissions for any of this. So we'll buy 100 shares of SLV, and the reason we buy 100 shares is that each options contract, each call contract covers 100 shares. So if you want to do this with 1,000 shares, you would buy 1,000 shares, and then you would sell 10 calls. I'm doing sort of the smallest version that one can do. Obviously, if you do 100 shares of gold, it's going to be much more. You're going to need much more capital in your account. So we buy 100 shares of SLV, and then we immediately sell a call option against it. And it's important to buy the shares before you sell the call option. Otherwise, you end up with something that's called a naked call option. You don't want to do that. But you buy the shares, and then you immediately put in an order. And some brokers will allow you to do this simultaneously, called a buy write, where you buy the shares and then you immediately write the calls or sell the calls. Those are sort of synonyms: selling covered calls, writing covered calls. It all means the same thing. But we basically buy 100 shares of the stock or of SLV. We sell one call, and as we saw, we'll be selling just to the bid. You might be able to work the midpoint of the bid-ask spread, but for here we're just going to assume that we're selling it right to the bid for 238. And because each call option controls 100 shares, there's a multiplier involved. And so if you want to discover how much premium you're going to collect, you just take the price that you sell the call option for, 238 times 100 times 100. And so we know that we will be collecting $238 in our account. Now, when we do this, we'll get cash in our account, we'll get $238 in our account, and we'll also get a short position in this 25 call. And that will be equal to sort of negative $238. So when you first put the trade on, these things are going to net out. It's not going to look like you collected anything, but we're going to go through some scenario analysis here and see what happens as we get to expiration. Now, the amazing thing about this, which you probably noticed, that this is an amazing return on capital actually for just 60 days. You are making, if we just take 238 divided by 2458, which was our capital outlay, we're making almost 10% in just 2 months. And to put this in context, savings accounts currently pay about less than 1% for a year. The stock market has historically returned about 10% per year. And so here we are making this in just 2 months or 60 days. This tells you that the trade, that the market is volatile. This might be a risky trade. And so you have to take that into account. There's rarely any reward without risk, but if you happen to be bullish on silver, this trade may make sense for you. If we annualize that, that's a 9.68% over 2 months. That's 58% if you can do this every 2 months. So very nice return by any measurement. So what happens in different scenarios? Well, if silver, and again, silver is currently trading at 24.58. So if it stays below 25 at expiration, and we're just going to look at what happens at expiration, because this is something that you can trade out of it before expiration, and to trade out of it, you're basically going to first buy to cover the call. You'll buy back the call, and then you'll sell the shares. But let's just assume that we hold it to expiration. That's how we normally do it. And I should have mentioned here that this is actually a sell to open order. You'll have a choice of when you enter into a call option trade, you can buy to open, which means you're going long the call. In this case, we're going to sell to open. And if you want to exit before expiration, you will use the command buy to close. And then, of course, buy in the SLV, you'll just buy as if we were buying a stock. So what happens if SLV is below 25 at expiration? Well, in that case, we get to keep the 100 SLV shares, and we also get to keep the premium that we collected. That call option will expire worthless, and we will see that we have $238 in additional in our account, which is very nice. It's a way of sort of creating income. And as we said, the call option will expire worthless. This is if the call option expires out of the money. In other words, this is a 25 call option, and if SLV is below that at expiration, then we keep the shares and we keep the premium, and the call option just goes away. It disappears from our account. And when we check our account the following on October, I guess it would be October 19th, the Monday after expiration, we will see that that call option has disappeared from the account. Now, what happens if SLV is above 25 at expiration? Well, in that case, what happens is the shares, the 100 SLV shares we have, are called away, because by writing a call option, we've given someone else the right to call away our shares, and they will indeed be called away or taken from us at 25, assuming that SLV is above 25 at expiration. If it's right at 25, I believe they will still expire. The call will still expire worthless because it will have a zero value and no one's going to call it away. So basically, if SLV is at 25.01 or more, this is what will happen. The shares will be taken away from us at 25, and so we'll have an additional capital gains of additional profit of just 25 minus the price we paid, 24.58 times 100 shares. That gives us another $42 profit, not counting commissions. And so in addition to that premium we collected, that $238 premium that we collected, we will have that $42. So a total of $280, which makes this, puts us a lot closer to 10% rather than 9.68%. Now, what happens, and in that case, the call disappears as well. Basically, the shares are taken away from us, and we end up with cash in our account. We just have another $238 than we had when we first put the trade on. If you do this with a dividend stock, you'll also possibly get paid a dividend while you wait. But obviously, silver, as a precious metal, does not pay a dividend, and gold is not either. But if you did this with something like Microsoft or Apple, you would get paid, assuming there was a dividend payment in that period where it goes ex-dividend. You would also get a dividend in addition. Now, what happens if SLV falls a lot? Well, if SLV falls a lot, we'll be no worse off than we would have if we had just bought SLV. And that is simply because if SLV falls a lot, in other words, if it still closes below 25, we're still going to get to keep that $238 premium. The call option will expire worthless. But because we collected this premium up front, you can think of it as sort of cushioning the fall. And so if we paid $24.58 for the shares and we collect $2.38 per call option, that gives us, if we just do $24.58 minus 2.38, that gives us our break-even price of $22.20. So in other words, we don't lose any money all the way down to $22.20 because we've collected this premium, which sort of helps to cushion the fall. Below that, obviously the worst that can happen is SLV goes to zero. This would never happen because it's a precious metal and a commodity, but it could fall a lot. Anything could happen, especially in 2020. It could fall down to 15 or something like that. And so that's where the risk of the trade comes, and that's why you need to be bullish on it, or at least think that SLV is going to stay around 24.58 and or go higher. So that's how the trade works, 9.68% in just 2 months. Now, if you want to go into a little bit more depth in covered calls, more than I was able to do in this video, you can check out my paid course at Trader University. I have a whole course on Make Money with Covered Calls, which discusses not only covered calls in depth, but also cash secured puts, which is another way of doing the same trade, and also poor man's covered calls, which is great for accounts, for much smaller accounts. If you join Trader University Premium, in addition to gain access to this course, Make Money with Covered Calls, you get access to all of my courses, all 13 courses, which includes Learn to Day Trade Like a Pro, Learn to Trade Stocks Like a Pro, Learn to Trade Options Like a Pro. And you can click on any of these. I'll stick a link in the description notes below. It'll give you the list of lectures, as well as my list of favorite momentum stocks, how to make money with IPOs, swing trading with options, etc. And in some of these I go, especially in Learn to Trade Options Like a Pro, I really start at the beginning and lead you through very simple options strategies, discussing exactly how they work and all this fancy terminology like expiration and strike and in the money, out of the money. If you really want to go in depth, that would be the course for you. So if this is something that interests you, you can just scroll down here and click Get It Now. And that'll take you to the checkout page. Normally access to all 13 courses, including Covered Calls Made Easy, is just $125 for 30 days access. There are no long-term contracts or anything like that. So you can watch all of the lectures and then cancel before your subscription renews. But I want to give you a special coupon today. So if you just scroll down here and click Have a Coupon Code YT99, as in YouTube 99, that'll take, and you click Update, that'll take $26 off the monthly subscription price. So instead of paying $125, you'll pay just $99. Again, gets you access to all the courses, including Make Money with Covered Calls. And you'll really learn how to apply this to stocks as well as to commodities like we did today with silver and gold. So be sure to check that out. If you found this video helpful, hit that subscribe and like button. Hit the notification bell if you want to be notified when my next video comes out. And let me know your questions and comments in the comment section below. When you first start trading options, they can seem a little weird, but the more you do it, the more familiar this terminology will be and the more comfortable you'll be with covered calls. Thanks a lot for listening, and I'll see you in the next video.